Welcome to Halftime Report. I'm Sonal Bhutra and with me are Manglam Malu and Ekta Batra. Good afternoon, guys. Well, another quiet day, so to say. The Nifty has fallen around 50 points from the opening highs. But nevertheless, we have a couple of these stocks which are moving around across sectoral indices. We are seeing some green barring Nifty IT and Nifty Realty. But those two also absolutely flat with some negative bias. Not many cues as far as the domestic markets are concerned. But definitely, global markets will be in focus, Ekta.
Well, yes, Manglam as well as Sonal, thanks. Welcome to the show as well from me. But nonetheless, it is turning out to be a day as well as a week where a lot of the macro cues are going to be in focus. And, you know, I was just looking at the global developments. New Zealand, you can't really ignore what's taken place there because they've hiked rates by 75 basis points. And this is the highest ever rate hike which has taken place by the New Zealand Central Bank in its history. So that's quite momentous. Separately, they have also hinted at further tightening. Just want to point out that we had the Singapore inflation data for the month of October, which was released today as well. And the October CPI, in fact, has softened a tad bit. It's coming at around 5.1%. The street was anticipating 5.3%. And it is versus 5.3% in the month of September. So this is definitely a positive that, yes, there is some amount of softening which has taken place in terms of the Singapore CPI. Fed minutes today, so that's what the street will be bracing itself for. And remember, this is ahead of the US CPI data, which is due on the 13th of December. I'm not talking about India because we have the RBI policy, etc. But nonetheless, this is just the macros that I'm discussing on a global scale, where, yes, New Zealand did hike rates, highest ever in its history.
Well, as far as India is concerned, the only thing that everyone will be watching out for is the November series expiry tomorrow. And that is something that we'll be monitoring because tomorrow the US markets are shut. But today we do have a fair amount of cues coming in. And the FII long positioning is 68%. Is there a case for further short covering or not? Just as we're below that all-time high for our market. We'll watch all of that, but we'll leave all of that to tomorrow as well. For now, we do have with us Aptus Value Housing Finance, their first the second quarter numbers that the company reported. Strong growth momentum continued for them, and as they promised, their asset quality as well improved. So we do have with us Mr. M. Anandan, who's the chairman and MD at the company. Thanks a lot, Mr. Anandan, for joining in. You had earlier promised that, you know, asset quality will improve and the first quarter was just a blip. But as far as the loan growth is concerned, you know, that is something that I'd like to ask you. This quarter, you've done around 32%. And you had guided for around 25 to 30% growth this year itself. What's driving this loan growth and how much do you think you'll end this year by? Will it be above that band of 25 to 30%?
Yeah, thank you. You know, given our customer profile, which is largely in Tier 2, Tier 3, Tier 4 cities and self-employed and housing for their own occupation, and our given the size of the loans, the demand for housing and housing loans are fairly high, and the pie is large, the penetration is low, and we are seeing the growth coming back fully after the COVID. So we did recorded, as you mentioned rightly, good growth of little over 30% on our loan book in the first 6 months. And going forward also, we expected to, you know, we expect to maintain the same growth rate of about 25 to 30% CAGR, into the future.
Okay. Mr. Anandan, you know, like Manglam mentioned, there's been an improvement which has taken place in terms of the asset quality. But what can you guide us for when it comes to collections and recoveries, probably in the second half? Do you expect the kind of momentum that you've seen in asset quality to continue into the second half? The reason I ask is that we're working in an environment where there are layoffs taking place by tech companies globally. Inflation is on a downtrend, but obviously central banks are tightening. So given the context of what might be taking place, what do you foresee in the second half?
No, our asset quality is good and our collections have substantially improved. And the last 3-4 months, our collections have been little over 100%. And given our size of the loan, size of the MI, the impact of inflation, not really affecting in relative terms as much as the other segments of the home loans, possibly. But So we are really seeing a good repayment track from all our customers, resulting in our stage one is almost about 94.5%, and our stage two is around 4.5, and our NPA is around 1%. And this we expect to continue into the next 2 quarters also. In addition to that, we have also taken a decision to follow a prudent provisioning policy, and we have substantially increased our provision in the current year. Right now, we carry about 1% of our entire loan book, we carry as a provision. And for NPA, we're really providing about 25%. Okay. So that way, both in terms of the recovery, collections, and the provisioning is good enough for us to sustain into the future as well.
Okay, so that is the idea on your asset quality, and generally you've given a growth target on loans as well. Let's talk about your net interest margins, because we are in a rising interest rate scenario. This time there was a decline of 5 basis points. It's a minuscule amount, but it has declined nevertheless because of higher borrowing, which increased around 27% on a quarter-on-quarter basis. So what is the idea on NIMs? Will they continue to stay stable, or will you see some decline in coming quarters?
No, actually, for FY23, we don't see any decline in our NIM, primarily because of our very strong balance sheet and very strong liquidity position. Our balance sheet size as on September 22 is about 7,000 crores. Of that, closer to about 3,200 crores are net worth, and balance 3,800 is the borrowed funds. Within that, 60% of the borrowed funds are fixed interest rate for another 5 years. So, it's a long-term loan with a fixed interest. So the inflation, the increase in interest rates will not impact us, at least on the immediate short term, on that 60%. And the balance 40% of 3,800, about 1,300 crores. Also, it's linked to the 1-year MCLR. And to that extent, we have leeway. And our credit rating also has been upgraded in December 21, and that also we are leveraging to, not to really go for any increase in our borrowed costs. On top of all these things, we also got a sanction of about 500 crores from NHB, which has not been drawn. And, the NHB funding comes at a, relatively lower cost than the bank and other sources. That also we have kept it undrawn. So given that, we expect at least for FY23, we don't expect any increase in our funding costs, and we don't expect really any reduction in our NIM. Broadly, NIM will be same as it is today. And as you know, we enjoy one of the best financial metrics, whether it is NIM, ROE, when compared with the comparable companies.
We take that point, Mr. Anandan. Your AUM is growing extremely fast. Your asset quality is under control, and at the same time, you don't foresee any big risk to NIMs, etc. So you are doing well on all those parameters. However, one niggling worry is that, as your book grows, your operating costs also are increasing. In fact, this time around itself, your employee costs were higher by 49% quarter on quarter. At what point does operating leverage kick in? I mean, what is your target cost to income ratio going forward?
Basically, as you must have noticed, our OPEX is one of the lowest in the affordable housing finance industry compared to other competitors. And the increase, you are right, there is some increase in our manpower cost, in this period. Primarily because if you look at, while the loan book has grown about a little over 30%, our disbursements are really grown almost 60%. And part of our cost, a variable component of the cost linked to the disbursements also is one reason. And second thing is that, when you really compare, in fact, on a year-on-year basis, FY22, April 21 is fully closed because of COVID. Whereas FY23, it's a 6 months data. FY22 is a 5 months data. That also is there. And our increment period also comes from effective, first of April, first of May kind of thing. So, but barring this kind of specific issues, inherently our productivity is one of the best. and our OPEX is one of the best, and they'll continue to be so into the future as well.
Okay, sir, just before we wrap up, I just wanted a quick word from you with regards to which segment are you probably betting on in terms of growth, because you have your regular home loan segment, but you have this quasi home loan segment also, which is basically, houses which are directly for construction and the loans given out to the individual for that. If you could just give us which segment are you probably betting on in terms of incremental growth, and between the two, any slowdown?
Basically, at a broader level, there are two segments. One is our home loans, which in a way include the quasi-home loans also. And the other segment is our loans to the small businesses, SME loans. Now, SME loans is a much lower percentage, of close to about 6,000 crore loan book. SME portfolio, it's about 700-800 crores only. There, given the impact of COVID and given the repayment culture, the growth rate will be slightly lower. But we will continue to have a very strong growth on the home loans and quasi-home loans. Quasi-home loans also mentioned is almost home loans, but it is not meeting the regulatory requirements in some form.
Okay.
But otherwise, we are expecting a very, very good growth to continue into the home loan segment.
All right, so we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Aptus Value Housing, talking about the fact that maybe the Ross NPAs will be maintained going into the second half as well. More statements on your screen. But as we take a break, this is a quick programming note to fully commit to the cause of bridging the gender parity gap at the workforce. CNBC-TV18 is all set to lead charge with a one-of-a-kind mega initiative, Future Female Forward, the Women's Collective, presented by HSBC. The initiative will be officially launched through an exclusive on-ground event on Friday, November 25th, in the presence of Shireen Bhan, our managing editor, CNBC-TV18, Mr. Hitendra Dave of HSBC, and other women leaders of India Inc. Also in attendance will be some of the most influential voices from the business, entrepreneurship, and entertainment spaces. Don't forget to tune in to CNBC-TV18 on this Friday, November 25th, 5:30 p.m. onwards. Welcome back. Well, it's just about consolidating with a little bit of a positive bias. Just watch out for a couple of these hospital stocks as well as pharmaceuticals. So Apollo Hospitals is your top gain on the Nifty, doing well today. So up around almost 3% for Apollo Hospitals, which has picked up around 4% on a week-to-date basis. And even something like a Dr. Reddy's is up around 1%. Banks continue to show momentum. So State Bank of India is up around 1% odd. Kotak Mahindra Bank from the private banking space, Kotak, is up around 0.7%. But time for more stocks in focus. And Nykaa, we've been talking about that ad nauseum, and there is more news on it, considering that the CFO, Arvind Agarwal, stepped down. This took place post-markets yesterday. Mangalam, tell us more.
Well, it is the CFO has resigned. The bad news continues for Nykaa. Yesterday, we got the news that the CFO has resigned with effect from November 25th. Will be pursuing other opportunities in both the digital as well as the startup space. But that's not the point. The point is that this is the third big exit in recent months from the company. And we've seen that in a lot of the other companies as well. But for Nykaa itself, the CTO, the Chief Technical Officer, had resigned from November 1st, Sanjay Suri that was. And also the CEO of their private brands, Reena Chhabra, resigned in August. So these are all old hands. They've been around in the company for almost 5 to 6 odd years. Them resigning at a time when the stock price is down almost 50% from the start of this year, 60% from their post-listing high. And especially after the massive selling that we've seen in the stock, once the bonus shares were credited and once the lock-in was open for investors to sell, does not bode well. In fact, it's not just retailers or HNIs who are perhaps selling. It's also funds which have held the counter from pre-IPO days, the kinds of TPG, Lighthouse, a lot of these anchor investors have been selling in the last few days. And that does not bode well, and which is what we're seeing in the way the stock is reacted to this news today as well. But we're talking about a lot of these investors selling in Nykaa, and why is Nykaa? A lot of these other new age companies as well. So we'll throw it to Vivek out here, who's been detailing all these numbers on a daily basis, tracking who's selling what, and now he's put together a list. Vivek.
Well, that's right. So what we're doing is we're trying to analyze the underperformance of the new age businesses given the sharp selling pressure we have witnessed in these names. Let's have a look at the 4 listings that recently saw their lock-ins expire, which has actually led to sharp selling pressure via large trades and block deals, especially from some of the pre-IPO and anchor investors. So the lock-in of Nykaa, especially when you're talking about it, the lock-in ended on November 10th, 2022. And as we mentioned, some significant block deals have happened here, none larger than Lighthouse India Fund, it's almost completely exited its entire stake in the company via multiple block deals on multiple deals. Also remember, when you're talking about Nykaa, the announcement of the bonus issue and the delay in terms of crediting of the shares into the demat account was something that actually led to a delay in the selling. And this is why you've seen continuous block deals that have transpired in Nykaa after the lifting of or after the expiry of the lock-in state. The next company that we are looking at is actually Delivery. Now in Delivery, Carlyle, a major investor in Delivery, actually held almost a 5% stake, out of which it has gone ahead and exited half of the stake. The lock-in expired on November 21st, 2022, and after which, you've seen a 50% of stake reduction already coming in. And now, the worry as far as Delivery is concerned is, how much do they own more? And this is something that the market is keenly awaiting. Moving on, PB Fintech, when you're talking about this particular company, it was seen as a disruptor as far as the insurance space is concerned. But it has also been a victim of disruption in its own business model, given the input of Bima Sugam. Now, it's also facing selling pressure from anchor investors. The company's lock-in ended on November 11th, and post which, you've already seen quite a few block deals happen. One of the major investors that have exited stake significantly has been Tiger Global. Now, post which, they own a little less than 1% stake after this particular block deal. Lastly, Paytm, it's been the one that's seen the biggest decline in terms of facing selling pressure. And, since its listing, and since from the IPO price, the stock is down over 70%. One big seller in this name has been SoftBank. SoftBank has sold almost 2.93 crore shares. And the other worry is that Alibaba owns over 31% stake. So that is another company to keep an eye out for in terms of upcoming or impending block deals.
Okay, all right, Vivek, that's a precise summary. Thank you so much for joining us with all those details. And with that, we move on and we talk about Zee Entertainment, that is higher in trade on the back of TRAI announcing implementation of new tariff orders. Vaishta is joining us to tell us more on this one. Vaishta?
Hi Sonal. Well, TRAI has made some amendments to the new tariff order 2.0 yesterday, wherein they say that as per the earlier new tariff order 2.0 version, the pricing on channels forming a part of the bouquet were capped at 12 rupees, which has now been changed and revised to 19 rupees. Also, as per the earlier new tariff order 2.0 version, there was a capping on the discount of 33% for bouquet prices, but as per the new NTO 2.0, the broadcasters are now allowed to offer 45% discount. So that is a benefit. Also, we have to wait for the implementation of this new tariff order, which is down the line and it's another 2 months to go. Also, the channel pricing list, which is required to be submitted on the 1st of Jan 2023. Nuvama feels that NTO 2.0 implementation is positive for all the broadcasters and they expect a good recovery in the advertising revenue for broadcasters due to the gross margins which are improving for the consumer companies. So net seems positive for all the broadcasters as subscription revenues now have the potential to increase in an environment which already has a subdued advertising revenues. Back to you.
All right, Vaishta, thanks a lot for that. Meanwhile, just also focus on the news at the bottom of your screen. Let's get in Yash on this exclusive. Sources tell us that RR Kabel, which is backed by TPG, is readying for an IPO next year. Yash, we were just talking about TPG selling some of its holdings in new age companies, and now it's looking at an IPO for an old business, which is cables.
Well, that's correct. On one hand, we're talking about these private equity players selling their stake. And this one is a new entrant that we're given to understand. And Manglam, if you're getting your house renovated or getting a major electrical job done, there's a high possibility that you would have seen a box there on the wiring. Speaking about RR Kabel, the company primarily is into low density electric cables and house wires. As far as the IPO itself is concerned, what sources tell us is that TPG backed company, that is RR Kabel, is readying itself for its public issue. Now, as far as the process is concerned, they've started hiring investment bankers already for this process. About 8 investment banks have been kept where presentations are being given. As far as the IPO itself is concerned, our sources tell us that the company is looking to file the DRHP for its IPO by May 2023, and by October 2023 is when tentatively they are looking to launch their IPO. As far as the details of the IPO is concerned, it's a large part of offer for sale and a small part of fresh issue, which means the funds coming into the company. As far as offer for sale is concerned, we've been given to understand a total fund of about 1,500 to 2,000 crore is likely to be raised through this IPO. Dilution of 13 to 15% is what is expected. The valuation through this IPO that the company is eyeing is about 11,000 to 15,000 crore. Now, TPG is looking to sell about 10 to 12% of its holding in the company through this IPO. Kabra family, the promoter family, is looking to sell about 2% stake in the company through this IPO. As far as the total stake is concerned, TPG owns about 21% stake, and Kabra family that owns about 74% stake in RR Kabel. Key competitors in the market, of course, Polycab is there, KEI Industries, as well as Havells.
Thanks, Yash, for that.
Just
so that is on. Go ahead.
Yeah, just a word on the holding company, Ramratna Wires. That's a listed company out here, and they, will stand to benefit from this. And maybe some part of the street was sussing that out, because as we speak, as the story came by, the stock was majorly in the red in today's trading session, has just moved higher. Ramratna Wires is the stock that we're talking about, and in just the last 6 months or so, from a price of 80 odd rupees, it's currently trading at a price of 180 odd rupees. So it was in the works. There you have it. Ramratna Wires is the one which is...
So there's some interest, and that's the holding company of RR Cable. So that obviously that stock would see some interest. That stock up around 2%. But talking about the IPO market, after that 17% gain or premium that we saw for Keynes Technology yesterday, it's seeing an up move of around 1.5 to 2% in today's trading session as well. So do keep your eye out on that particular counter. Time for a break now, but Aditya Agarwal will join in to discuss the technicals. Stay tuned.
Welcome back. We're looking at the Nifty now closing in towards that 18,300 mark, and the up move actually started from yesterday's last hour where it opened higher, and this morning while it opened higher and subdued around that 18,250 mark, we're meandering around 18,300, and that's where the action for expiry tomorrow has moved into. You just take a look at the 18,300 call as well as the 18,300 put. Both of them are extremely active. 74 lakh shares written on the 18,300 call. The 18,300 put comes up for you. That one too has almost 51 lakh shares written for a combined premium of 100 odd rupees. The smart money is eyeing a range of 18,200 to 18,400. But what's interesting this time around is that there could be a case for a bit of a breakout, or that's what the street is positioning itself for, because while this range is eyed, just keep an eye out on that 18,600 call as well as the 18,700 call. Together, they've added close to around 50 lakh shares in open interest, 32 lakh shares for 18,700 and almost 28 lakh shares for 18,600 for a premium of 1 to 1.5 odd rupees. If the market was to go higher, this is a punt that the bulls are taking. Were we to break out, maybe these premium from almost 1.5 to 2 odd rupees could go much higher, and they would benefit from that. But does that tie in with the technicals of the market? Aditya Agarwala joins in to tell us more. Aditya, are we looking at a breakout, or maybe the range will play out?
Good afternoon, Manglam. Thanks for the show. Doesn't look like it's breaking out either today or tomorrow. We'll be surprised if it breaks out actually. But at the moment, it's a very tight range, to be honest. On the upside, it's 18,350, 18,400, which the bears are defending very carefully. And on the downside, 18,250 for the day is an immediate support. If that breaks, we again slide down to 18,150. So it's this narrow band between 18,150 on the downside to about 18,400 on the upside, where Nifty is oscillating, and there is a bit of volatility between that range. Same holds true for Bank Nifty, though it has made a new high today. It has broken out from a narrow consolidation phase, but again on the upside, 42,750, 42,800 is acting as a hurdle. On the downside, 42,550 to 500 is a support zone. So both the Nifty and the Bank Nifty are more or less in a narrow tight band, while your broader markets are surprising, and there is stock-specific activity which continues to dominate the street.
Okay, what would that stock-specific activity that you're talking about for you? Individual technical picks, name a few.
A couple of buy recommendations on the upside. So on the metal pack, JSW Steel is something which is looking attractive. After a bit of a consolidation, some of these stocks are looking attractive. So JSW Steel traders can look at buying, look at a target of 740 on the upside with a stop at 701 on the downside. The second stock recommendation is MCX. That is also looking very attractive. A positive reversal on charts. So on the upside, 1600 could be the target, on the downside 1510, 1520 could be the stop loss.
Okay, all right, Aditya, we're going to leave it on that note. Thanks very much for joining in and giving us all of your picks. So that's on the technicals. For the markets, Bank Nifty is managing to outperform marginally with a gain of almost 0.5%. Time for a short break. We'll get you more stock-specific action on the other side. Stay tuned.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Let's get you another exclusive now. Sources say that a deal is brewing in Adar Poonawalla's Poonawalla Fincorp. Nisha Pudar is joining us with all those exclusive details. Nisha?
Thanks for that. Yes, sources with direct knowledge have confirmed to CNBC-TV18 that Poonawalla Fincorp's 100% subsidiary in the housing finance business, that is Poonawalla Housing Finance, is put on the block by the parent company, is what we gather from at least 3 sources directly involved in this particular process. What we do gather is that the investment bank, which has been hired by the company, is exploring and is speaking to select private equity as well as strategic players to sell the entire company, and the valuation expectation by the listed company Poonawalla Fincorp for its 100% subsidiary for a sale is around 3x of the net worth of the company. They had reported around 1100 crore rupees of net worth in the September ending quarter. Now remember that this particular company had earlier stated in May this year that they are looking at growth capital of raising about 1000 odd crore rupees and looking at selling stake, where the board had approved up to 15% stake sale. So we did gather that they had hired an investment bank which had explored with several private equity players and financial institutions on the sale of a minority stake of the company. And in the scenario of that breakthrough not happening of a minority stake sale, while the company of the housing finance is a cash guzzling business, needs growth capital, they have now put it on the block and are talking to certain select private equity players for selling this particular entire company. Also, one thing to note is that we did reach out to the company and they have stated that we had already started the process of a minority stake sale, and they have no comments to offer beyond that particular thing. They had also shown an intent of an IPO sometime back without giving any timelines.
Okay, all right, Nisha, thanks very much for that. So that's on Poonawalla Fincorp rather. Just to put it into perspective, the disbursements for the housing finance subsidiary in the previous quarter was up quite significantly. It was up around 57% on a year-on-year basis and 14% on a Q-on-Q basis to over 600 odd crores. So just keep that in mind in terms of a couple of statistics. But nonetheless, let's focus on a couple of stocks within the pharmaceutical space. The day is not complete without talking about that. I'll start with Aurobindo, which is in focus. That is because we did manage to access the Form 43, which was issued to their Unit 9. Remember, the Unit 9 was inspected from the 10th of November to the 18th of November, and it was issued 10 observations. It's basically a unit which is an intermediate API manufacturer. Now, this particular plant had already received an official action indicated status in May of 2019, which already makes it more vulnerable in terms of a position. It was then re-inspected in November 2022, and those 10 observations that we've accessed, though experts say that it is not related to data integrity, which is the most serious form of observations, it would probably take some time for them to resolve and see the end of the road for it. So that's on Aurobindo. There was additional piece of news. They've entered into a license agreement with Aviv Biotech for a particular chemotherapy drug. This particular drug, in fact, is under a late-stage review by the US FDA. So Aurobindo, if in case this drug does hit the market, has tied up a marketing agreement with Aviv. So that's basically the piece of news on Aurobindo. And lastly, just keep your eye out on Lupin, because Citi has written on Lupin. They have a buy. They've raised the target price to 840 rupees. Spiriva generic, which is basically an inhaler, is what they've spoken about. If it is approved, Lupin is expected to enjoy exclusivity in a market which is worth $500 to $700 million for the next couple of years. The product, in fact, has the potential to repair margins, according to them. And if it is delayed, they believe that the downside is limited because there's a strong flu season in the US, and the impact of Suprep, which is basically a bowel drug, can help in terms of margins in Q3. So they're optimistic with or without Spiriva generic.
All right, we take that point. Thanks a lot for that. So that's our daily dose of pharmaceutical stocks. Meanwhile, just keep an eye out on NBCC at the bottom of your screen. Up almost 9%, has been doing well for the last few trading sessions. And giving it company is Container Corp as well, which is doing well. So a bunch of these PSUs actually doing well too. Let's slip into a short break. On the other side, we'll focus on the new listing on the street, Inox Green Energy, in our special segment, Insight Edge. It's been a weak listing, the stock down 8%.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, on to our special segment now, Insight Edge. Today, we are focusing on a new listing, Inox Green Energy. It was a subdued debut for the stock, and it listed at a discount of 7.7%, and that's further worsened, as you can see on your screen. We have with us Vivek Iyer, who is here with us to tell us about the details and the key takeaways.
Well, it's been a subdued listing as far as Inox Green Energy Services is concerned. Remember, Inox Green Energy Services is a subsidiary of the listed entity Inox Wind. And, when you're talking about the IPO itself, the company raised almost 740 crore via the IPO route. Now, this particular amount was split into two. One was an OFS where Inox Wind actually is going to use the proceeds of this to pay debt. And even what was going to come into the company via the fresh issue, that also is going to be used to pay debt. So when you're talking about this particular group and Inox Green Energy, it's part of the Inox GFL group. So three listed entities is what we have. We have Gujarat Fluorochem, we have Inox Wind, and we have the latest listed entity. So what does the company do? The company is a major wind power O&M, so it does operations and maintenance, and majority of the order book for this particular company comes from the order book of Inox Wind. So when you're talking about Inox Wind, it manufactures wind turbine generators and provides turnkey solutions as far as its customers are concerned, and it provides long-term O&M services for wind farm projects as well. So the portfolio of the company, close to 2,750 megawatt. We had the management on our channel some time ago, and the key takeaway was that they're quite aggressive in terms of further paring down their debt. They hope to be debt-free by the end of this fiscal. And also what they're saying is that they're open to quite a few acquisitions as well. So it'll be interesting to see what kind of acquisitions that the company is targeting, and going to be profitable as well from FY24 onwards is what their stated aim is.
All right, Vivek, thank you so much for joining us. That's all about the new listing. Let's in fact listen in to Devansh Jain, who's the Executive Director at Inox GFL Group, on company's targets going forward.
We've got about 790 crores of debt as of 31st March 2022. 370 is going to get repaid by the primary proceeds of the IPO. What that would leave us with is approximately 420. Over the course of the year, we've sold 4 SPVs, 3 to Adani and 1 to Torrent. We've recovered majority of the 100 odd crores which was to be recovered there. What is left for us to now action out is sale of the last SPV, which would be downsold in the near future for about 300 odd crores. So broadly, what we're aiming for is to make this company a net debt-free entity in the very near future.
All right, with that, we'll step into a short break. On the other side, we get our commodity segment going with Manisha Gupta, and this time around, she'll be joined with Kishore Narn.
Welcome back. Well, quiet for the equity markets. So what's taking place in the metals market? Manisha Gupta, Commodities editor, is standing by with her guest for today. Manisha.
Thank you so much for that, Ekta. Well, yes, I have with me Kishore Narne, who's head of commodities and currencies at Motilal Oswal. Kishore, hi, good to have you. And I want to start with the metals as a space where we have seen November as a stronger month. But in the recent couple of sessions or more, we've seen prices continue to come off as well. Well, yes, there's a lot to deal with. You have the US Fed meeting minutes coming up as well. But it majorly is how the US dollar also seems to be performing. That's weighing on. So starting with the overall sector first, and what would you want to watch out for moving forward from here?
Good morning, Manisha. I think, see, the commodity markets as a whole has come off from their peaks in the recent times. There are two major factors for that. One is the lower demand or dampening of demand from the China, which is going through its worst phase of COVID restrictions and lockdowns, etc. You've seen that actually most of the orders which have been there have been getting cancelled for December shipments and January shipments. Aluminum imports have been hurt. So I think overall that is dampening the sentiment. On the other side is the stronger dollar. So that's what actually making all the assets which are priced in dollars to be under pressure. So both of these things are expected to continue for a while. Though we're not bullish on most of the metals, but I think for absolute short term, if you're looking at next a week or so, probably we might have touched some kind of a floor and we would be able to bounce back. But the trajectory of the whole metals for the next 2 to 3 months will be downside itself.
All right. So another 2 to 3 weeks where you could be looking at lower metal prices. But as you mentioned, Kishore, there are a couple of pockets that you like within the sector. I want to ask you about copper first. And we've seen inventories continue to decline onto this one. But here as well, on-ground demand, as you said, is not picking up. What really works here?
See, I think when you speak to the industry guys, actually, the currently this is the season where the next 2023 TCRC contracts are getting negotiated and all those things, and it's becoming extremely difficult for these contracts to be finalized at this point of time because of the volatility in the prices. But I think looking at next February or March 2023, I think the prices should be somewhere close to around 610, 620 kind of thing. So overall, the trajectory will be on the lower side. So inherently, in short term, if the pullback comes to around 680, 685 is on cards, especially 675, 680 is on possible. So I would like to hedge or sell at close to around 675 to 680 range on copper. On the other side, I think if you're looking at a positive sentiment within the metal basket, probably aluminum could be one of those metals. Whereas the tightening of sanctions on Russia, it might be becoming slightly more expensive. Second is the higher gas prices and electricity prices in the Europe actually is calling off a lot of smelting capacity there. So aluminum is one of the metal which could be slightly positive because of the rise in the input cost, which is typically the electricity cost.
Absolutely. And aluminum does consist of the cost of production that is very high when it comes to energy and electricity there. Kishore, also, how are you looking at nickel and zinc? Because both of these are in some way connected to steel. And that, of course, is because of China. Then how are these couple of metals looking?
I think, see, nickel, it's coming off from its lows, and even the volumes have started to improve on LME. So though Indian domestic volumes have not been very positive, but I think LME has seen slightly an uptick, and especially last month there's been almost like 10-15% kind of rally from the bottom. So aluminum is not out of the woods, I can say, but it's a metal which in a longer term trajectory it should be looked out for. As this is as we go ahead and the green initiatives are pushed into the a lot of EV story plays out, nickel becomes extremely important in that trajectory, and this is one of the most beaten down sectors as well. But because the volumes are low, it's not a really tradable commodity at this point of time in India due to the lack of depth.
Right.
But I think globally it's a metal which is need to be watched for to the middle of 2023. We should be able to get a significant momentum in nickel prices.
Okay. Kishore, how would you look at the zinc prices also? Because here as well, we've seen a huge amount of volatility come in. Last month was a great metal to trade in. This month, not so much. The last 1 week has seen a very sharp decline.
I think, see, zinc is a primarily dependent on the construction and real estate market. So I think because the Chinese real estate market is going through a significant pain and the construction activity itself becomes a questionable at this point of time, though Chinese are trying to boost it up and giving some support to that sector. But I think the galvanizing industry is going through pain, and I expect this pain to continue. Probably we are looking at 230 to 235 kind of levels on the downside. So probably in a medium-term trajectory, it's still bearish.
All right. So that is the whole metal sector in a jiffy, where you are looking at some support coming in for aluminum, nickel, perhaps in next year. But the other metals perhaps could see some more downtrend before we start lucrative levels come in for those. Kishore, thank you as always for joining us and giving us a sense on all of that sector. With that, that's all the time that we have on Halftime Report. After the break, Business Lunch will take all the action forward.